Dave, Natixis recently completed a wealth management survey. You talked to a whole lot of advisors out there. So what's on their minds? What's their biggest concerns?
Well, I think what we found is in terms of their outlook, they're very positive on the business. They're finding some challenges in terms of how do you implement strategy. They're finding some opportunities to really grow. But one of the things that they're finding is they're kind of worried about disruption that's out there. Good example, they think they're going to be able to grow the business by about 17.5% this year in terms of AUM. This is all the big wealth managers. But how are they going to do it? So one of the big challenges is getting investors to invest beyond cash.
Well, the title of the report is The Eve of Disruption. Yeah. So clearly there's a lot going on in terms of concerns to the industry. However, there's a lot of private equity players putting money into it. So there must be something going on that makes people want to be in there.
Well, I'll tell you, the interesting part of it is there's a lot of disruption. We all know about consolidation. We know about fee compression, all these challenges that the firms face. But I think the two that came across most strongly to us were geopolitics as well as AI. So geopolitics, you look at what we've had for the past year, all these elections that have changed things in the EU, the UK, the US, France, Germany, India, everywhere. And what they're seeing is there's a change in policy, which is making them think about how they have to run their business differently because regulation will be different. And there's also kind of a change in the tone. So there's economic uncertainty that they have to deal with. On the AI front, they have to look at this opportunity that's being put in front of them and understand, will it help us grow the business, help us get better and more efficient? But there's 52% who say that AI is reaching the point where now robo-advice is becoming a kind of realistic threat to the business.
Can you dig deeper on that in terms of the risk they see out there? Because from an outsider's perspective, it seems like it's a pretty good business because of all those big private equity firms that want to be in it. And one wants to follow those firms generally.
Well, it's interesting to me that the theme of geopolitics came across in risk. We look at risk in two ways. First way we look at it in terms of the macroeconomic scene. And inflation's the top of the list. Right behind it are things like a new geopolitical conflict and expansion of the wars that are out there. Also, U.S.-China politics. We have a new administration, so they're worried about what happens in that. Now, the other part of it is they look at portfolios. Inflation still tops their risk, but they're equally worried about valuations. Right? They have to understand that they think this is a year that the market starts to recognize that valuations matter. The other thing that they're looking at in those terms, too, is where the direction of that is going to head. They're worried about volatility. And we've seen in the past 8 weeks, volatility is certainly for real in the markets right now.
Well, disruption often creates opportunities. Mm-hmm. So where are they seeing the glass half full to bring in more assets? Because at the top of the segment, we said they want to get those assets under management. Where are the best opportunities to bring those assets in?
Well, it comes to AI again, and they're looking at it in terms of the business in three ways, right? Opportunity, process, and then service. You think about the investment opportunity that's out there, they're telling us that 77% say that it is has the opportunity to expand earnings growth for more than a decade. See, they're worried about earnings growth, but they think this will drive it. The other side of it, they're thinking about their own process, how they get more efficient, how do they find opportunity, how they manage risk. AI is going to help them do it. They're telling us 50% will say that if you're not doing it now, you're going to become obsolete. The other side of the equation, too, is this demand for more personalized services. So we're seeing an uptick in the availability of separately managed accounts, where people own the underlying cost basis, they have a more personalized experience, and half of the firms we spoke to say they're going to increase direct indexing services on their platform so they can give their clients a better after-tax return.
And then finally, if you think about what wealth managers have been able to offer clients over the past 5 years, it really has grown substantially. Mm-hmm. Bitcoin, private credit, all these fantastic alternatives to help diversify their portfolios. So looking forward over the next 5-10 years, what else can they add to their offerings?
Well, I'd say there's two things that we're seeing play out. The first is model portfolios, and they're kind of a linchpin in the plan. If you think about it, it centralizes the portfolio management. They believe it gives them a more streamlined approach. They think it'll keep clients invested for the long term, but they also think of it in terms of giving clients a better investment experience. So they're grounding them in model portfolios. In fact, 59% of wirehouse firms are going to add to that platform this year. They're looking for tax advantage ones. They're looking for high net worth models. They're looking for alternatives models. The other side of the equation is private assets. We've seen a great move towards private assets, whether it's institutions or fund selectors or any of that group. What we're seeing is there's more demand for it. They think that private assets, particularly private debt and private equity, can help them when they're trying to provide diversification. They think that it can help them provide better returns, all these advantages, even manage that volatility they're worried about. But what it comes down to is it overcrowded? They say no. In fact, 6 out of 10 will tell you that the delta between returns in public markets and private markets is still great enough to invest.
All right, well, thanks for coming and talking about it.
Appreciate it.